And action. Take two.
Take two.
Good morning, guys. We have recorded, but we didn't press record.
My bad. I apologize.
So we're here, guys. Another Monday morning. I'm here with my co-host.
Kadeem Brown, back in the flesh. Yo, what's up, everyone? How's everyone doing? This is like the Matrix, bro. We went back in time.
The Matrix?
The Matrix, they'll go back in time?
No.
Yes, bro.
No.
Yes.
No, they don't. No, they don't. What are you talking about?
Hold on. So in the Matrix, you feel like you did it already?
Yo.
Yes. Have you not seen the Matrix, bro? In the Matrix, it doesn't feel like you did what's happening already.
No.
Deja vu. Yes, bro.
You mean deja vu?
That's like one scene though in the movie.
That's one scene in the whole trilogy.
That's what I got from it. Everybody gets something different from it, bro. What's up, bro?
All right, guys, we're here. Before we get started, we appreciate everyone's feedback. We appreciate everyone sending us emails, the topics you want covered, the questions you like answered. Highly appreciate that. One thing we really do want you guys to do, we're not asking for much. We're doing this for free. We just want you guys to rate us and also give us one person. Again, the thing with Apple and SoundCloud, all of that, they have it where if you rate us a 5, if you like us, give us a 5. If you don't like us, give us a 5 as well. Again, that's just how they go about doing it. Back to our time and everything. We're doing this for free. We're giving you guys knowledge. We're bringing guests here. Having fun with you guys. We just want you to tag one person or just share it with one person. It can be your mother, your father, your boyfriend, girlfriend, all that other stuff.
Yeah, definitely. Yeah, share. Hit us up on email at whatarewedoingpc@gmail.com. Send us the topics you want to discuss. Send us people you want to get on. Just ask us questions. Like, communicate with us. Y'all see, we've been live on the IG so far. Shout out to Jada again for holding us down. Yeah. So let us know what you guys want us to talk about, and yeah, let's get into it. What's up, bro?
Yeah, that's a second take, and my energy was down on that one too.
Huh?
It was like a nonchalant. Like, hey,
You wanted to start again?
Nah. Are you recording?
Yeah, I'm recording this time. I'm recording. Okay.
Oh yeah. Also, we have a guest with us today.
Special guest. Special guest.
It's going to be a very important episode, a very rich episode. Let me get my tie and everything suit up real quick.
So please introduce yourself again for the second time.
Oh man, I left my tie in the car, man. You ain't gotta do me like that, man. But to everyone out there, my name is Elzie Ross, financial advisor.
Dope. Where you from, bro?
I grew up right here in Valley Stream, man. We in Elmont right now, but Valley Stream is where I grew up.
Valley Stream.
Yeah.
Elmont and Valley Stream. You know, us Elmont guys, we look it down the Valley Stream. It's
Don't do me
like
that, man.
it's like, y'all came over to come to our school and everything. Nah, that's what's up. Thanks for stopping by. We appreciate you spending some time with us and to talk finance. I mean, this is a very important topic for everybody. You learn how to plan for your future, learn how to secure the bag, be financially free, take care of generations after you. So I feel like this is going to be a very important episode that we get on. So we really appreciate you coming out.
No problem.
What does it mean to be financially free?
Financially free, man. I get that question in every consultation. That's a concept. Mm-hmm. You know, it doesn't have any definitive answer because it's different for every person. You know, what might be financially free for you or for you, totally different, right. You know. But my goal is to kind of add that number to it. What do you consider financially free? You want a house? You want it paid off? That's it? One car? You're good? That's financially free. I'll get you there. Now, if you want to run a multi-million-dollar business where you know what, I can pass that down to the next generation, I can get you there too. But those are two totally different dynamics. So for each person, you know, it's really just a step-by-step, what's important to you, where are you trying to go, and ultimately, how do we get there?
So what exactly is a financial advisor for those who don't know but hear the term all the time?
So typically, every successful person has 3 people that they work closely with. You know, the 2 we're always familiar with, your accountant. Especially being an independent business owner, you need your accountant in your pocket. All right. Next is that lawyer. All right. Just in case we got to go over a contract. Someone said I did something, you fell in front of my property. No, my lawyer will handle that. Last is the financial advisor. All right. So when it comes down to making that money after you made it, that's typically what my job is. And a lot of people know how to be active in income. You know, let me do a job. You know, let me just create a business. Let me sell something. Let me offer a service. But what do you do when you get that money, the quote unquote bag?
Right.
Do you leave it in the bank? You know, do you chase something you see on TV, what everyone else is talking about? No, you consult with a financial advisor. Hey, this is where I want to be in 5 years. This is what I have currently. This is what I'm bringing in. How do we get there? This is what I want in 10 years. This is what I want for my family. This is what I'm acquiring. How do I protect it? So my goal ultimately is to find out, A, the best way to maximize your time, and B, more importantly, maximize your money.
So you said all the stuff, which is great. So when should I start thinking about that stuff? So you said all this stuff like getting going from active income to passive income and making your money basically work for you. So when should I start thinking about like, okay, I think it's time to go see a financial advisor?
And this is something I definitely wanted to clarify is the myths. You know, we talk about the myths of finance.
Here we go.
Here we go.
Let me put on my seat real quick.
I need a financial advisor once I have thousands and thousands and thousands of dollars to invest. Wrong. I need a financial advisor once I get out of this rut I'm in. You know what? I got to pay this off. And then once this is done, wrong. The best time to speak to a financial advisor is when you start working. Because you'll always find a reason to maybe buy a pair of shoes.
Yeah.
Find a reason, you know, for the ladies to buy a bag. You know, you don't need a financial advisor, quote unquote, for that. But you do it on your own. So if you are making money, you got to put it somewhere.
Okay.
And 9 times out of 10, the average person doesn't know where to put the money. You know, I come from a Caribbean background, so the bank is everything. You got a great savings account, you're good. And that's just honestly not the truth. So literally, once you enter the workforce, you should be considering talking to a financial advisor.
So you said that's not true when it comes to having a bank account is good. Why do you feel that's not true?
Well, the myth behind it is safety. You know, we look at the bank account as safety or principle. You know what? I can go to the ATM. I could check my balance. I could check right from my phone. I know my money is there. Now, I'm not saying it's bad, but it doesn't serve all purposes.
Right.
You know, emergency money. You know, my car breaks down. I got to fix a leak in the roof. Things like that, you definitely want to have some kind of check in a savings account to kind of pull from to handle those things. But it's not the end all be all. You know, and a lot of people think acquiring a large asset in the bank, 25,000, 50,000, 100,000, you know, that's a great thing. But one myth or one thing that people don't understand is inflation. You know, and that's a term people probably heard about it. Maybe they don't understand it. And just to keep it real general, to inflate is to get bigger. So the cost of living is increasing. So how's my money combating inflation? You know, I went to Elmira Kadeem, you know, so I remember after school, we would get that dollar pizza, man. They had the pizza, right? Everyone running downstairs to get the pizza. So, you know, at the end of the day, you know, it's 8 slices, so $1 by $8.
Yeah.
That's a whole pie. Can you get a pie today for $8?
Could you?
Maybe in Manhattan, but your stomach gonna be bubbling. So,
yo, we dollar pizza kings over
here. Now you go to Geno's. What's Geno's charging for a pie? $16.
Way too much money.
Doubled up. I graduated high school 10 years ago. So that's how inflation works. If you look at, you know, I don't know if anyone's into real estate, but that's definitely another, you know, source of wealth, you know. But look at the real estate market. You know, these houses ain't brand new. They like maybe 50, 60 years old. Look at what it sold for 60 years ago to the present day price. So we have to be able to combat inflation. I'm going to give you guys a number. The rate of inflation is 3%. Now, what's the average bank account giving you?
Maybe like point something.
Point something.
0.03.
I'm a credit union guy, so I got 1%. And I'm proud of my 1%. You know what I'm saying?
Up there.
I'm proud of my 1%. 1%. You know,
referral,
right? You know, so look at it like that. So if it's 1% and the rate of inflation is 3%, you're losing 3% of your money, but gaining 1%, so you're net -2. Compound that, and we'll go into that a little bit later. Over years, is your purchasing power like it's still the same? Nah, you're losing it. So the goal, you don't have to be crazy, you know, risky, but you definitely want to beat that inflation rate. You want to do at least 3% if you want to maintain purchasing power. Or if you know you really want to get advantageous, and you know, let's do for 5 or 6%, so I can make more.
So you're saying like that old Caribbean way of thinking of like keeping that money in the bank account and just holding it is like the worst thing you can do, because over time you're definitely losing money.
If your goal ultimately was to buy something in the next 6 months or a year maybe, keep it in the bank.
Okay.
If you're talking 18 months, 2 years, 3 years, then you definitely want to put that in some type of like investment vehicle.
And that's the job of the financial advisor, is to help you find that vehicle.
Exactly. So what typically we would do is sit down, go over your goals. What's important to you right now? Okay. Are we buying a home soon? Kids got to go to school. You know, depending on whatever it is, let's find out the immediate goals. Now, what do we have time for? All right, 3 years is going to happen. 5 years is how I envision it. Maybe you're making a career switch. Maybe you're in school right now. These are all things that are important factors. And now we get to 10 years and 15 years and 20 years. That's definitely something that you want to have invested. So we'll sit down, we'll go over everything, and then next is risk tolerance.
Okay.
Because when you think stock market, you think one of two things. Either the guy on Wall Street, you know, downtown, you know, driving his Ferrari, made all his money in the market, and then you remember 2008 when everyone's jumping off a building because the stock market crashed. Yeah. So a lot of people don't understand it and they fear it. They know money's there. Hey, listen, the stock market, CNBC, all right, it's moving. You know, something's happening, you know. But, I'm good. I know the bank is right there. I could walk up to it. I could check my account. I know what this is. I'm going to leave my money there. And that's just kind of like, I'm trying to combat that. You know, I want to make sure that you understand that, hey, listen, there's things that protect your money. You know, you don't have to go all the way aggressive or even speculative and really have some great gains in the market. Okay. So it's what are you comfortable with? And then we'll go from there.
So hold on, before this is going to get crazy.
Let's have fun.
I see it.
I'm here for it.
Before we really get onto that subject, let's rewind. Let's go back to what made you become a financial advisor. Okay. And when did it actually start?
So I was always interested in the stock market. Didn't really understand it, you know, until I started studying economics at Stony Brook. That's why I went to school.
Stony Brook.
Yeah,
okay.
So I went to Stony Brook. So, all right, economics is cool. I know that's where the money's at. But I was also working full time at T-Mobile. You know, I did the cell phone thing for a long time. And I had a 401k. But once they went public, they gave us stocks. So I'm like, all right, cool. This might be a good time. It's free. Everybody likes free. So, you know, they're giving me free shares. How does it work? I didn't know nothing about a restricted period, a vesting period. I just knew that it was fluctuating. And I seen that when they gave it to us, it was maybe about $16. But over a short period of time, it was $20 and then $24, you know, and then $30. And I was just like, this is actually kind of interesting, you know. Let me see what I can do with this, and that's kind of where I began actually trading, you know, for myself, and that's something we'll also kind of get into. But I had an event planning company, and you know, I used to do the whole parties in the city.
Yeah, I remember you're big on that.
You know, so I had to make that money. So actually, one of my clients, you know, he was a financial advisor. He knew I was in a sales position, you know, and he really came to me and told me like, hey, listen, like, you could be making a lot more money with your skill set. So everyone comes to you with an opportunity. So, you know, I'm already, you know, cool.
You think about to go into a meeting, sit down, watch the presentation,
show me the video, you know, and
all you need is 3 people.
Yeah, all you need is three people to get started, and those 3 people need 3 people. So, but I didn't know him, you know, so I gave him the benefit of the doubt. Right. All right. So I went into the meeting, you know, in the office, which was definitely not what I expected. And he really broke it down, and it went hand in hand with what I was studying, because I knew economics is what I wanted to do, but what was I going to do with it?
What were you? What was your major in college?
Economics.
Yeah, that was your major. Okay,
so I majored in economics. So I knew, like, all right, I got to do something with this. So kind of just, I thought it was fate at that point in time. Like, all right, well, you here talking to me about stuff that I was supposed to be doing anyway, so let me give it a shot. And, you know, it really just opened up my eyes, because I thought I had an understanding of the stock market, but that just really wasn't the truth. It was just really just the tip of the iceberg. Just so many different products, so many different strategies, you know, just to really accomplish the goal exponentially was right there. And, you know, what really wanted me to become a financial advisor is that I thought I had a good life already. You know, I'm not in, you know, any kind of bad circles. I'm in good circles, positive people, but we're not talking about this. You know, and I go all the way there. You asked me if it was nothing off limits. I'll be straight with you. The African American population. You know, that's really
that's what
it's really like we don't talk about it. You know, I know how crazy Kanye looks. I know what's going on with Kim Kardashian. Every 5 seconds, if I'm on the gram, Snapchat, we're talking about something that has nothing to do with our future. We're investing in other people's lives, but not in ourselves.
Right.
So literally, if I'm not getting this information, and I thought I had a pretty, you know, well-rounded shot at things, imagine the people who didn't. You know, imagine the people who didn't go to college. You know, imagine the parents, things like this. Because I'm the first generation to ever go to college. So this is something that my pops, you know, my mom not talking to me about. So now I have to educate them. You know, and that's really why I decided to become a financial advisor. Well, if I'm going to do it, I got to be able to touch the masses. I got to just let them know that there is something out there besides, you know, a get-rich-quick scheme. You know, there's something else out there. Let me teach you patience in the market. Let me show you how, listen, this is what happened back in the day to where it is presently today. You could have been a part of this, so don't miss the next curve.
So after college, what was the process of becoming a financial advisor? You said somebody introduced you to it. He talked to you about it. So what's that process like for somebody who would want to become a financial advisor?
So to anyone who wants to become a financial advisor, I'm going to give you everything you need, okay? Because there's certain, you know, companies, and I won't, you know, tell, you know, I won't say their names, obviously, but it's bare minimum. And I'm not here for bare minimum. I'm not going to give you something where you're going to miss out on an opportunity. So I'm going to give you everything. So the first license you typically need to have is a life, accident, and health license. That's in your insurance license, okay? So this will allow you to sell life insurance, you know, health insurance, you know, disability insurance, things like that, which are important things people need. But that's the base. Okay. Now, some companies say, hey, listen, you have this insurance license. We can do certain things with this. Take this, run with it. But that's not the way you want to go about it. You want to go further. All right. The next license you're going to want to hold is the Series 7. Okay. And the Series 7 is the general securities license. Right. It allows you to do the stocks. Allows you to do the bonds, the mutual funds, the open, the closed-end funds, things like that. Everything, the world is your oyster. Yeah. Now, there are some limited licenses that, you know what, you can do mutual funds, but you can't do stocks. You know, so what happens when you sit down with that person who really is looking for a stock-based portfolio and you can't service them? Doesn't help. Legally, you know what I'm saying? The politically correct way to legally. You know, that's something that you want to have, because that's the only way you're going to get paid for it. And I believe firmly that you all should be paid for your time.
Of course.
If you add in any kind of expertise, you know, don't be afraid. You know, maybe start off for free, you know, let people know what you do, but you should be paid for your time.
Okay.
You want to go?
Is a college degree necessary?
It is not necessary, actually. Okay. You know, you just have to have a clean background, you know, nothing too crazy. And debt is definitely important. Each firm has different qualifications, you know, obviously, but anything that's dealing with stocks, you know, you definitely can't have any kind of record. You know, that's important.
Criminal record or
criminal record.
Okay.
What kind of criminal?
Typically, anything, misdemeanors, it depends on what you did, you know, anything with fraud, you know, forgery, things like that. It's an automatic, you know, disqualification. Right. Felonies, 10 years. Like if you never been convicted of a felony, you can't apply for 10 years, you know, things like that. And you still have to disclose, that you were, you know, even charged. You know, it's that serious because it's very regulated. You know, if, you know, God forbid, you want to know who you're doing business with at the end of the day. So, you know, a lot of companies don't want to back you if you kind of got a shaky background. So that's important.
So now you said you don't need a college degree. Like going back, like say when you were like before you went to school and you knew you wanted to do this, or say you know you want to do this in your future. That's what I want to do. Would you take that college route again, or would you recommend somebody to go to college, or would you recommend somebody just to jump straight into this?
It honestly depends on the individual. I think college does help, you know, because you're still an adolescent when you graduate. You don't really know the world. Yeah. So I feel like college is a great experience, allows you to kind of get some life experience, and then you kind of really get the transition into adulthood. Is it required? Absolutely not.
Would you do it again?
Would I personally do it again? No.
Okay.
You know, at the end of the day, and, you know, my mom, if you hear this, I'm sorry. But I feel college, you know, it's not what people, you know, it's not what's always cracked up to be. You know, like a lot of people say, education, it is important. Okay. I will say that.
Very important.
Education is important. but I didn't say where you have to get the education from.
Agreed.
You know, and it's just certain life experiences that really college just can't teach you.
Right.
You know, and a lot of people come out with such like outlandish debts. You know,
79K here.
I'm like 60, 68 or something.
Oh, so you got me beat.
Oh, you've been paying it off.
I've been paying it off, man. Because you know,
been paying it off. He's at 69. Was 69?
68, man. 68.
Man.
So you know, and slowly but surely, I had to pay that off.
Yeah.
You know, and that's going to a SUNY school. So I know some people that went to Spelman.
Jeez.
You know, Clark. You know, I want to go to the historically black college. You know,
Yeah.
I want the experience.
It's good marketing.
It's great marketing when you say it, but you know that $200,000 overhead is crazy. You know, you could be driving like a Bentley or by a Corsa. You know, like
me personally, I feel that the best thing about college is the network.
Absolutely.
And I feel that many people, they lose that part of college because they focus on grades, they focus on getting that paper, but not getting the people.
You know, it doesn't help or hurt. It really comes down to the individual. Me personally, you know, my greatest success hasn't, you know, it didn't come from college. You know what I'm saying? Like, it came from networking. So honestly, gaining, you know, clientele, managing accounts, you know, most of the people I went to school with are not my clients. So, you know, that was a big factor for me. And I think school is definitely important, but, you know, you got to know what you want to get out of it. You know, and a lot of times we go to college because it's the next step. You know, I started school as a computer engineering major. You couldn't tell me anything else. I was going to be building computers, making it happen. Like, that was my career path. Now I got into my first class. I'm like, this ain't for me. You know, but my mom already signed off on it.
She already drove you down there and wished you off.
You had like, you know, a couple of choices growing up in a Caribbean household. It's either doctor, lawyer, engineer, disgrace to the family. And I didn't want to be the latter. You know what I'm saying? I think I did okay with financial advisor. I was able to kind of stick it in there. But, you know, again, with school, it's really just what are you looking to get out of it?
All right, so now we're leaving the college part.
Yeah.
So now we're going to the stages of becoming financial advisor.
Yeah.
How important, how difficult it is for you to get the Series 7, for you to get the
Series 7 typically is equivalent to like the bar exam, they say. For financial advisors.
Explain it.
So literally, it's an 8-hour test. It takes you a couple months to kind of study for. It'll really give you the differences, and it's going to get technical, but like maybe calls and puts, options trading, you know, things like that. Like, how do you hedge a portfolio? What kind of products can you use? What's an annuity? Is it variable? Is it index? It's really in-depth stuff, and you know, these are all the things. This is the steak and potatoes you're going to be talking to people about. You know, I say it's a third license as well, the Series 66, what allows you to charge a fee, you know, for your services. You know, for what, you know, managing an asset, giving investment advice, things of that nature. So I say the licensing process, if you were just a dedicated student at that point in time, back again, maybe 3 months. You know,
3 months?
And what's the cost like on that? How much does the cost get to that point?
It depends on who you're with. You know, like where working with me, like, you know, the only thing I would say someone coming on board that's born to you is the insurance license that you do pay for. But I personally pay for your Series 7 and your 66 because you do have to be sponsored by a firm. You can't really take these tests just because I feel like doing it. You know, you literally have to have someone say, hey, listen, I'm willing to hire you. All right, you know what? And sometimes they make you pay for it, or, you know, depending on, you know, who you're working with, you know, they'll pay for it for you.
So when you started, the firm who hired you, how much were they giving you?
So as far as like salary or compensation wise, okay, so typically obviously I can't say any names, but you know, different firms give different payment schedules. And a lot of times when you go into something like this, you have your own business. You know, you're in business for yourself, but you're not by yourself. So that's kind of how it's structured. That's a politically correct way of saying it's commission.
Correct
way of saying it's commission. But they did offer me a salary. You know, nice. And I knew where I wanted to go, and I already had my own business, so I understand how that works. And I feel like a salary is it's a crutch to me. You know, I felt that, you know, and if I knew at the end of the day I was guaranteed a check, how hard would I really work? Right. You know, would I put in that extra hour? Would I make that extra phone call? Would I send that extra message? Probably not. So I chose the path where, you know what, I didn't have a salary. It was 100% commission. And you know what? I just grinded hard.
Yeah, I think one of the episodes we talk about like the best things to do, like not have that crutch, like you said, of working that 9 to 5, of going out there. I mean, at 9 to 5, you're capped on how much you can make at the end of the day.
Exactly.
When you put commission and throw commission in there, like you make as much as you the work you put in.
No cap.
Exactly.
Yeah,
so yeah, I think
Right.
we talked that in a previous episode. So that's good to hear that's what you did basically. So that's not bad at all.
And a lot of people kind of like they like to run away for commission. You know, they like guarantees in life, you know, and I always tell people nothing's guaranteed. You can have a job for 10, 15, 20 years and, you know, they can be handing you your walking
like
papers at any point in time. So if you have the opportunity to do something where you'll be paid for your performance, because I had the corporate job.
Yeah.
I had you know, showing up early for work, helping everyone out, doing, you know, extra things, and star employee, and then someone's cousin got the job.
Yeah.
So, you know, that's typically how that life works, and I knew that's not what I wanted for myself. And I call spades. You're not getting the 7 figures that way, or 8 figures. You know, if you want to be a millionaire, you know, in your actual lifetime, because when you get past 55, 60, it's not really a lifetime. You want to be doing it at you know, millennial age, 25, 30. Literally, entrepreneurship is the only way you're gonna do it. This is me.
You just jumped over like that 5-figure, the 6-figure mark. It went to like 7, 8 figures.
Yeah.
When did that 6-figure mark be like, okay, that's nothing to me? Like I can make 6 figures tomorrow if I wanted to. So you're shooting for like 7 and 8 figures right now.
That's the goal, you know. And you know, when I first got started, I think I was towards the end of the year, so I got started like in you know, in September, like when I had all my licenses. You know, like
what year?
2000,
end of the year.
2016 is when I was fully licensed.
Okay.
So I might start the process maybe like, you know, 2014, 2015.
Okay.
You know, I really wasn't sold on the concept. I liked it, but I wasn't sold. So you know what? You go back to what you know. That when things don't work out the way you wanted to, you go back to what you know. And that's what I did. You know, I took a step back from the industry and I went back. But when you get a taste of that life, you know, you can't go back. And it was kind of really eating at me. So I was like, you know what? Let's go hard. So I fully had on my license, I would say, in September of 2016. And I think from September to the end of December, I made about 80 grand. You know, and that was just like 3 months towards the end of the year when Christmas shop is going on. You know, stuff like that. I made that. So I was like, whoa. Now, I'm not going to say that's everyone's story, but I know what I wanted to get out of the industry.
Exactly.
And I didn't stop until I got it. I think I made my first 6 figures maybe like 2 or 3 months after that. And it was cool. You know, and what people say, and we all do it. You know, when you first start your job, you know, I was working as a camp counselor. I was making like $7.50.
Yeah.
Oh, that's really what it was. You know, for the summer, I made like 3 grand. Like, yo, if I made 10, if I made 10, boy, y'all don't even want to know what I would have did. And I started working T-Mobile, and then at that time, I made like 25. I was like, wow. Yeah, but if I make 50, you know, it's going to be different. And each level, you kind of, you go up.
What if I make the next one? The next one,
because your taste change, and that's not everyone, you know, because not everyone has that opportunity. Some people getting 2% raises, and that's not a bad thing, but that's not for me, you know. And I help everyone, you know, whether that is for you and you like the security, and I got my, you know, my pension job, and I put in my 25 years. I couldn't live like that, so I needed that unlimited earning potential. And you know, when I first made my first 6 figures, it was just like, okay, I pretty much have done everything that I wanted, you know, on a large scale. I got to revamp the goals. You know, I got to go to the next level. You know, and that's really when I started really like doubling down and shooting like to get there.
Right. So that's also the importance of once you hit a mark. Now I got to break that ceiling.
And you talked about your goals. So like, so how long was it before we get in your goals? Actually, how long was it before? Because you have your own firm right now. Okay, and how long was that transition before you were working for somebody until you felt like, okay, I can do this on my own. I can branch off and I can start running the ship.
Okay, so typically, and again, it's all who you work with or work for at that point in time. Some you know, firms give you an opportunity where they'll sponsor you or they'll work with you. You know, they'll be that backbone for you. And then other people will be like, yo, peace out. You're not working here. Figure it out.
Yeah.
You know, and, you know, obviously speaking, I had to do it for myself. I can market a brand, but there's no better brand to market than myself.
Of course.
So, you know what? I told them that was what I needed. And they was like, you know, we appreciate your honesty, but we want to be a part of that. So I was able to kind of, you know, maintain the relationship there. I do have my own thing, but I still have my partnership with them. Dope. So, you know, that was just a blessing.
Yeah, you don't want to burn that bridge.
And that typically, that was just relatively recently. I've done this is probably like June. The June of last year is when I talked to them about it, and I think everything got finalized because, you know, I was telling the guys, like, you know, compliance is real, so, you know, at the end of the day I could talk about my stuff, but it was really finalized, I would say, at the end of January. So it took about 6 months to kind of get everything going. I was with the firm maybe like a year at that point.
Congratulations, by the way.
Yeah, thank you.
Yeah, definitely congratulations. Yeah. So right now you have people that are basically like employees, basically.
Yeah.
And how what's the process like for you vetting employees?
So typically, I give them the same experience. You know, at the end of the day, like, it's ironic we was talking about the Matrix, man. I make them like an Agent Smith here. You know?
You see, I told you that would come back. Everybody was laughing at me beginning of the episode, but look how it turned.
Agent Smith. You know, gotta just duplicate the process. You know, I'm gonna give people what I know works. I'm not gonna try and reinvent the wheel. I'm gonna give it to them as it was given to me. So, you know, study. You know, get your first, you know, license. Yeah. Then let's go out and start running. Let's see what kind of people you know, what people you have access to. You know, if you want a cold call, it's all available to you. You know, so it's whatever they get their niche for, and I want to discover that early.
Of course,
I don't want you to go through the whole process and it's just like, all right, now who do we talk to? I want you to kind of get into that aspect, get that feel first. Like, this is what it's like to be a financial advisor, and then see what you like, see what you don't like, and just gravitate to the things that work positively for you. So, you know, walk them through the licensing process, you know, get them started with their prospects, you know, educate them on the products, you know, at that point in time they become well-oiled machines.
So I'm sure that was a big goal for you to check off. So, like, what are some of your other, like, shorter term goals that you're looking to check off as well?
Definitely some short term goals is to retire my mom. You know, like, you know, my mom, like, she stayed home my whole life. Went back to work when I was 16, and has been working ever since. You know, so, you know, she's up there in age. She's in her 60s, and the last thing I want from my mom, and then, you know, my father, but he makes a lot more, but it's to have her work. You know what I'm saying? Like, you gave your life to your kids, so can I give your life back to you? That's just the kind of, you know, my goal, and I'm trying to do that at the end of this year.
Dope.
You know, like, really just giving her, like, whatever, however I can structure it, so it's tax advantage, but, you know.
He's scheming over there.
You got to. Yeah, she's an employee of the other business.
She cooks for us.
So, but that is definitely, you know, the goal is just to retire. Then after that is to just pay off my parents' house. You know, give them that, you know, so that peace of mind. You know, just to not worry about having a mortgage anymore. Just pay your property taxes. You know, go on vacations for like a week or two, stuff like that. That's my immediate goals. I got into this industry because I wanted to give back. Not for myself. I have my personal goals, but I got to take care of the people that took care of me first.
Of course.
You know, and ultimately, again, it's just to really, as far as me personally, it's take it to the next level. You know, like, being on a platform like this, like, honestly, it meant a lot. You know, just to have a voice, of course, you know, so people can kind of hear what I had to say outside of, you know, my regular reach.
Of course.
So ultimately is to really branch out, you know, really take this to the next level.
Right.
And the Millennial Advisor, that's typically how they refer to me, is because most people in the financial industry don't like to talk to millennials. And it's frustrating, you know. I'm 27, but it can be frustrating is because everyone talks a good game, they say what they want, but they lack discipline. It's good for 1 or 2 months, and then it's like, oh, I can't do this anymore, you know. Well, next week is, you know, Memorial Day weekend. I got clients asking me, hey, can we stop, you know, investing? Because I got to go to Vegas. And I'm just like,
Miami's about to be lit. Vegas about to be lit.
I got to go. Miami's coming up, and, you know, I just want to,
take a month off.
And they feel that they don't have large capital, You know, and some of the things you hear about the industry is true. You know, every advisor, when they up there and they've been doing it for like 20 years and 30 years, they don't want to touch the account if it's got less than $1 million, 1.5 million. You know what I'm saying? So I didn't want to go into business like that. You got $20, okay, let's make it 30. All right, then that's the way that I felt I was going to build the best relationships. So ultimately is to branch out to as many, you know, millennials as I possibly can and give them the gems that were given to me, and not for the 1% that has already had it, you know, and I could make them more money. But, you know, for you to get there, to get to the next level.
Yeah.
Do you still do that now?
Yeah.
In reference to the amount.
To what?
Like the least amount. Let's say someone comes with you $20.
Yeah, that's the truth.
That.
Honestly speaking, even if you're under, you know, all right, cool. The process is really, we have the goals. Next is the budget.
Right.
What are you bringing in? What's going out? Are you living above your means? Are you living at your means or below your means? And if we got to rearrange things and we got to tweak things to make sure, you know, it's advantageous to you, let's do that. You know, let's really get you in a great position. Yeah. Because advertising is like a $1 billion industry. So they're selling you something when you don't realize it. And you got to understand, all right, cool, this is what I can spend on frivolous things.
Right.
But this is what's going to go towards my future. And you never live life now at the expense of your future. And a lot of people don't really understand that concept. It's because it's what we see all around us. We are secretly in competition with each other for whatever reason. You know, you got an apartment. All right, cool, I'm living better than you. All right, cool, well, my car's better than yours. All right, well, my shoes are better than yours. And what is the purpose of all of this? Why?
Yeah, dope. So, all right. So you talked about you like $20. Boom. You talked about when your first job, you're making like $7.25 or something like that. Back then, would you recommend to your old self saying, "Yo, find a financial advisor. Let me not spend this $7 on Jordans or whatever you were spending on back then. Let me take some of this and give it to a financial advisor, even if I was like 14 or 15, so I can start planning for my future." Should you start that early, or when should you start?
Absolutely. So a lot of times people want to get invested in the market when they're older.
Yeah.
You know, everything is for old people. You know, all right, well, stocks, I don't need that right now. I need to go to the club on Friday. So start as early as humanly possible. Even if you're under 18, your parents can open up the account for you. Okay? If you're over 18, you can do it for yourself. All right? And I'm here for numbers. Let's talk numbers. All right. So Warren Buffett. Let's start with Warren Buffett. He bought Berkshire Hathaway. He started investing in 1962. Each share was trading for about $7.50, my hourly wage. My hourly wage. Now, granted, this is like 56 years ago. Right. But Berkshire Hathaway, one share, $300,000.
Jeez.
$300,000. My $7.50.
Just one check. Just 1 hour.
1 hour is $300,000. Now, granted, well, that's 55 years ago, 56 years ago. Okay, let's bring it up to speed. So I graduated high school in 2008. All right. Now, I was pretty sure I was asking my parents, because I didn't really have no crazy job, but, you know, I was asking my parents for Jordans, you know, for clothes. Yeah. You know, I wanted a car. I got grandma's old car for $1,000. You know what I'm saying? So, one thing that was trading for, let's say, $80 roughly was Amazon. Yeah. It was just a bookstore. You know, and it was going for $80 a share. Now, I'm pretty sure I asked my parents or bought something at that point in time that cost me more than $80. But Amazon's trading for $1,500 share right now. The largest marketplace on the planet. You know, and things evolve. You know, and that's the big thing. Am I putting my money into things that are going to inevitably evolve? Okay? Now, we're going to go over assets versus liabilities. What is an asset? Asset is something that has the potential to appreciate or grow in value. Okay? A liability is something that we purchase that will inevitably depreciate in value. So whether it's that car, it's that watch, you know, it's the jewelry, you know, clothes. These things don't retain value. Only certain collectibles do it. We're not buying collectibles. We're buying Yeezys. You know. So you got to look at it like that. Like, you know, what am I putting my money into that's going to inevitably appreciate? And I wish, you know, if I could hop in a time machine and talk to 16-year-old, 17-year-old me, you know, yes, get yourself some new shoes. You know what I'm saying? Go to the movies every weekend, but take like $20 or $50 or $100 and put it into something.
Right, that little bit,
and let it grow.
Let it compound.
Yeah, a lot of people don't realize the you mentioned like get rich quick schemes.
Yeah.
Like that's what everybody's looking for. Everybody's looking for that big come up. Not like you mentioned Warren Buffett as well. He didn't make most of his money until he was after 50 years old. Yeah. So he's working his whole life, and he just kind of inevitably seen his return on all his work he put on after 50 years old. So not a lot of people know the time that you have to put in to become whatever that financial free goal is, or to start getting a return on your investment. Exactly. And that's why I want you to emphasize how young you should start, and you should start right away. It doesn't matter if you're making $20. It doesn't matter if you're making $100 a week. Go start right now, because the power of compound, I want you to go over that a little bit, what compounding is. Eventually your money will grow. Your money's going to start working for itself eventually. So you could touch on like the power of compounding, what compounding is. And I think like a lot of financial advisors talk about like the rule of 72.
Yeah, how long it takes to double.
Okay, yeah. So definitely touch on that, and like the power of starting early. Like what's the benefits you're gonna get out of starting so early?
Okay, so first thing would be with compound interest. Okay, and they say there's a saying, if you don't know what compound interest is, you pay it. Yeah. And if you do, you earn it. Now, this is for the people that, you know what, we're a little bit older and everyone's like, I got a credit card. I got the Macy's card. I got the Nordstrom card. I got the Saks card. You know, I got my Chase card, so on and so forth. So let's just give you a common example. Now, if I have $1,000 balance on my Chase card, okay, it's carrying over to the next month. I check my statement, see $20 on there. That's compound interest on the negative side. Okay, you're increasing your balance on what you owe. Now, what you earn. Let's flip the script. Let's say this was an investment account and you had $1,000 when you first bought something, but now when you check your statement, maybe like a month later, it's $1,020. Everyone wants the latter. You would like that situation,
of course, yeah.
But if you don't know where to put your money to get that situation, that's typically where the gap is. So the power of compounding, literally, the younger you are, the more time is your friend here, the more time you have to compound. As a matter of fact, if you're in your 20s and your 30s, you can put less money away now than the person who is 10 years older than you, putting in more money trying to catch up. Inevitably stop putting money into this account and still come out on top. Because that's the power of compound. It's like a snowball. So once you have an asset that's appreciating, maybe it's paying a dividend, maybe its value is increasing, like the Berkshire Hathaway kind of example. By the time you're ready to use this money, it's just grown so much. Hopefully you don't know what to do to, you know, how to spend it at that point in time. You know, and the thing that we're seeing a lot more of is, you know, you're seeing a lot more senior people going back to work. And again, it comes back to just, it's not 100% because they're bored, because, you know, everyone likes to use that analogy, like, I have never seen a bored 75-year-old in CVS. Okay, this is not for fun to them, you know. So at the end of the day, I'm bored, let me go work for 9 hours. You know what I'm saying? Like, it's not that. It's for the fact that their fixed income, that pension, which doesn't change, you know, that Social Security, which is not changing, it's not keeping up with the purchase power. Okay, so we want to use compound interest to inevitably increase our purchase power in the future. Comes down to that, you know, inflation example I use. We want to beat the 3%. Okay, we want to make sure we're doing at least maybe 8, 9, 10. You know, let's get real advantageous. You know, 12, 15. You know, and that goes with risk tolerance. You know, a lot of people like the numbers, the high numbers. Yeah, but you gotta have the high risk tolerance. You know, like a lot of people, they come in and like, okay, cool, you know, and I'll say on the record that I can't advise cryptocurrency. It's not regulated,
of course,
but I could talk about it. So when Bitcoin was, in its height, and everyone's like, it's over 10,000. Everyone's calling me like, I need Bitcoin. How much I gotta put in to get this Bitcoin? Because I'm gonna be a millionaire by tomorrow. Because that's what everyone else is doing, and let me follow that. And that's just not how it works. It's speculative. So it's the riskiest type of investing you can possibly do. It should be the smallest piece of your portfolio, and
Not
you
the
want to
largest.
build your whole portfolio around it. You're not an experienced trader. Okay, you want me to do all that work now? Hey, now, wait a minute, now. You was just a little bit upset about this conservative mutual fund. Said it's moving too much, but now you want to talk about trading currencies. So,
That volatility is no joke.
yeah, that volatility, and just the people that may not know that, it's just how things go up and down and how quickly it happens. That's what volatility is. But compound interest, definitely the rule of 72 is how long it takes to double your money. Obviously, the higher the interest, the average interest, I should say, the shorter it takes. So, like depending on what the scenario is, I believe 8% is like almost like 10 years or something like that.
Crazy.
That's crazy.
How do you feel about mutual funds? No.
How do I feel?
No. Let me ask a different question.
Go for it.
What are different types of investments?
What are the different types of investments?
Yeah.
Oh man, it's a lot to go over.
Let's do it. It is though. Let's do it. The main ones that the basic or average
Investor?
person doesn't know.
Doesn't know.
Yeah.
Okay.
Let's do
cool.
that.
So I'll do the ones that they typically don't know, and then I'll compare it to the ones that they do know.
Okay.
So something that people don't typically know might be options trading. That's really advanced. Okay, that's something that we're inevitably we want to get to. But I wouldn't typically start there for an investor.
Okay.
And maybe like calls and inputs and things like that. So what these things are is like a promise to buy or a promise to sell. Okay. So basically, if you have a call out there, you know what? All right, well, I know I can buy this at this price. A put is, all right, well, if something drops below a certain point, you got to buy it for this price that I said we were going to sell it to you for. Now that's really advanced on top of the schedule, okay? So I'm going to go even lower, all right? Something that we might want to talk about is a structured note. Okay. And what a structured note might be, something that might be index linked. We could talk about that too. So what an index is, like the S&P 500, that's an index, all right? So it follows like the blue chips, like Home Depot, Apple, the things all right? So what these products might do is they have holding periods. It could be 1 year, it could be 3 years, it could be 5 years. So it locks your money. So it locks your money, but it's mimicking the performance of an index. So why would someone lock up their money? Well, there's a guarantee or maybe a buffer is what it's called, saying, all right, well, if you lock up your money for 5 years, if the market ever goes negative 25%, you don't incur that loss. We'll eat that loss in exchange for you locking up your money. But they may give you unlimited upside. So the S&P is doing 40%, over that, which would be great. It doesn't know that much. But, let's say, it did, like the average like 10 to 15%, if I'm being honest. So if it did 15% in 5 years, you get all of that gain.
Yeah.
But any year that it went negative, you don't incur that loss up to 25%.
Okay.
That's a structured note. All right. Now let's compare it to something that you do know. A CD, security deposit. You go to your bank for that.
The worst investment.
I wouldn't say it's the worst investment.
The worst investment.
Don't do that. Don't do that.
The worst investment.
That's debatable.
No, it's not debatable,
It is,
bro.
bro. We're not getting into
No,
that. We're
it's
getting into
the worst investment
ever.
Well, it depends what you're trying to do with your money.
It
No,
all
CD's
depends.
worse. You're gonna you end up losing. Anything you got to go to the
No, you
bank.
just hold it.
Anything you got to go to the bank for, bro. I feel like it's the worst investment.
No.
Here's the thing, though.
Yes,
Not
bro.
anything.
But typically,
not anything. We both know that. Come on.
Bro, what do you have to go to the bank for? That's a good investment. What? There's nothing. They push CDs down your mouth. Like there's I don't know. I'd rather go to a financial advisor than go to a bank.
Yeah,
Because
but we didn't say that though. You didn't say that.
Well, here's the thing, and I'll clarify that. Like a CD, it's not bad, but it is not for everyone.
There you go.
Okay, so
Politically correct. I'll take that.
You have to say that it's not bad, and that's a big thing about being a financial advisor or any profession where you're talking to someone who's not familiar with it, with the jargon, understand it. So I'm very particular on how I word things. I will never say a CD is a bad investment, but growth, the type of growth.
But for me,
CD and growth don't go together. Okay,
that's what I said. Depending on what you're trying to do with it.
But CD and preservation of capital do.
See?
Okay.
Preservation of capital.
Because sometimes many people they don't know how to be disciplined and not touching it.
So people like CDs because there's no fees and they're getting a better interest rate than they'll normally get
in the savings
account.
Of course, yeah.
I don't need the money, so let me just leave it here. I was gonna leave it anyway, so I might as well just lock it up, get a better rate of return, and be good with it. But to compare maybe a structured note to a CD, same concept. There's a lock period, maybe 1, 3, 5 years. But when we're talking about that interest
percentage,
rate, that's typically where the growth is. Maybe the structured note has a ticket of 3%, so you got to pay 3%, a fee on that, to buy that typical product.
And these notes, what are like the minimum requirements? How much like the minimum they're asking for them?
There's literally like hundreds of them. So it could be 5,000, it could be 10,000. Okay, some of them are 15. Depending on what they're giving, then the more. Of a investment that they want.
Okay.
So you also have something called a market linked CD. So same concept, but maybe it's not as much growth, or the ticket or the charge on is a little bit smaller. But anything that you're gonna really pay less for, obviously you're not gonna get the same amount of growth.
Right. The reason why I brought up mutual fund is because I feel that's more of generally what the average person knows. They know stocks and they know mutual funds. That's what they care about.
Yeah, I think
and
Drake
I wanted you to break.
Song.
I want you to break down.
Yeah, Drake mentioned it in his song. Ain't nothing mutual about my funds though.
Perfect. I want you to break down mutual funds as well as the interest.
Okay.
Because I don't think people understand what interest does with mutual funds.
Okay, so let's take a look. Let's take a step back. Let's go what a stock is. I think that's important. We can talk about that. So a stock is equity or ownership in a company. For example, I have an iPhone. I think we have the Apple table over here.
Yeah.
So
no
Android over here. I have Android in my pocket. You can stay in here, baby. So Apple, let's say it trades. I think it's going for like 118 or whatever. I don't know. So I haven't checked it.
Hypothetically.
So hypothetically speaking, it's going for $118. All right. So let's say I bought it at $118. I am now technically an owner of Apple, a very small one, but still an owner. So what happens is that, let's say the iPhone 34 comes out and everyone's like, oh my God, I need it. Their valuation, their revenue increases. So now my equity, my share, is worth more. All right. So let's say it's going to $125. If I sold it, I made $7. Not bad. All right. Let's go on the flip side, and let's say I own Starbucks at let's say $50 a share. And there was some bad publicity about a couple of individuals inside hypothetically a given Starbucks, and they got the police called on them. People are not spending their money at Starbucks. So my value, my revenue, it's all going down. So maybe it's valued at $40 now. If I sold it, I lost $10. I lost money.
Yeah.
Okay. And that's typically what people understand of the stock market. So let's go over now to a mutual fund. What a mutual fund is, just different stocks in different sectors all in one portfolio. So you could have technology, you have commodities, you can have healthcare. It gets creative depending on who the portfolio manager is. And it's all these different stocks in different sectors. So the way I always kind of make the comparison is I can take $100 right now and go to Roosevelt Field Mall and spend it all on Apple. Yeah. Not going to get much, but I could,
Get a charger.
I could get a charger. Wire sold separately. I could do that. Or I can take $2 and get an Apple, $3 in Starbucks, $5 in Microsoft. So basically, I'm putting my money in different places. The reason why people do this is that it takes the overall portfolio to either be positive or negative to control the shift.
Mm-hmm.
So whereas if I had all my eggs in one basket with a stock, you know what? If it's going up, I'm super happy.
Mm-hmm.
But if it's going down, I am panicking.
Of course, of course.
Whereas if technology got hit hard, but you know what? Pharmaceuticals are doing well.
Mm-hmm.
You know, maybe that balances out. Maybe I'm stable. Maybe I'm still in the green.
Mm-hmm.
But it takes a lot more to be in the red. So typically people like to go with mutual funds because it is a more conservative way to invest. You can still take advantage of great gains, but it's more conservative.
How about that fee?
So typically when you're going with a mutual fund, you're paying what's called a sales load.
Mm-hmm.
Some of them have no sales load. Some of them have they can range all the way to 8.5%.
Mm-hmm.
So depending on what the ticket is, you know, that's what, you know, it controls. It's all up to the fund, you know, whatever they want to charge. That's not the advisor. The advisor doesn't charge that. It's whatever mutual fund that we're talking about. That's what the fee is. Now, when you're going with fees, and a lot of people like to think, all right, well, let me go with the low fee one. Low fee doesn't mean great performance. You know, so when we're looking at mutual funds and I'm giving you options, I'm going to give you some that may have high fees, that may have low fees in the middle. But what we're looking at is net returns. A lot of people get consumed with the 1 year number. All right. That one small piece of the pie. All right. So if I have a mutual fund that did 15% last year, all right, and the fee on it was 5%, I netted 10. Is what it is.
Right.
Now, what if I had a 1% fee on a different mutual fund, but they made 10%? Technically, I'm net 9.
Yeah.
You trying to say you would rather have the low fee one? No. The other one performed better.
Right.
So when you're looking at it, we got to go, what's the performance versus the fee? What are we netting? And, you know, if that's something that we want to stay within. Yeah.
I'm glad you talked about mutual funds because a lot of times, often, when I first started, I was buying individual stocks. Like, I started when I was 16, 7, you know, playing around on TD, Ameritrade and stuff, like losing money and stuff. So I started around buying individual stocks. So as I matured and got like more financially savvy, I realized that individual stocks is kind of, for me, not the way to go. Right now, my portfolio is the Vanguard Index Fund. That's what I invest my money in. And a lot of people come,
Low fees.
Yes.
No fees for me.
A lot of people come to me like, what stock to buy? What stock? Should I buy this stock? Should I buy that stock? And my response is always like, I don't buy individual stocks. For me, I rather buy an index or a mutual fund and be protected and have such a big diverse account than rather buy individual stocks. If Apple crashes tomorrow, somebody says something bad in the Starbucks, guess your whole portfolio is taking a huge hit rather than just buying individual stocks.
I agree 110%.
Okay, so that's what I always recommend. Like, yo, look into index funds and that's just go. And let's talk about index like dividends. So like a lot of people will buy. One of my mentors told me, I forgot what stock I was buying one time, but his first question was, what's the dividend it's paying you? How much is it paying you? Like, what's your monthly return on it? And then the advice he kind of gave me was like, yo, don't ever buy into a company that's not paying you out when they make returns a month. So talking to like dividends and like, I'm investing all this money 20, 30, 40 years down the line. When can I start putting money back in my pocket?
So typically when we're having a dividend conversation, you know, because it's important, you know.
And what are dividends for people
basically, who don't know? A company's doing well and, hey, listen, we're doing well, so we want to share the profit, which was almost like profit sharing. You know, now dividends are not guaranteed.
Of course.
Okay. So it depends on, you know, how the actual company or companies are performing. You know, because you can get dividends within a mutual fund as well if that's within the holdings. So if you're going with a dividend, you know, sometimes it might be like 1%, you know, 2%, depending on, you know, what type of fund or stock that you're holding. People like dividend because it's actual money that we're getting right now, you know, and the larger your asset is, you know, basically if I was getting on $1,000 worth of, I guess, stocks, you know, if I got back like $1 a month,
that's something.
All right, it's $1 a month. Get to $1 million. Get to 10 million. Now you're getting anywhere from like 1,000 to 10,000 in just dividends. That's paying bills on its own.
That's financial freedom. That's the way to
financial
get there,
freedom. So it's a way of, and are you actively earning that income? It's passive. You don't have to do nothing for that, but own it. So if you own it and it's giving you dividends, that's definitely a plus, you know. But one thing I definitely want to make sure you know that those dividends are taxable. You know, a lot of people like they get dividends and they are not taking it to their like tax people.
Yeah.
Okay.
Take that to your tax person because again, you have dividends for like 20, 30, 40 years. The IRS has no mercy on anyone. You know, hey, I see you had this because you got to report it because they're reporting it.
Right.
You know, when people, you got to look at it as two sides of a coin. They're writing this stuff off.
Yeah.
Okay. So if they're writing something off, they're saying that they're paying it to you. They're filing it. Hey, listen, I paid him this money. You're saying, I ain't never seen this money.
Yeah.
Someone's lying. So at that point in time, you do want to make sure that you are claiming your dividends. But definitely, it is a great way of building passive income. All right. So it all depends on, the kind of person you are. So typically with my dividends, I just reinvest them. I don't take them.
Same here. Yep.
I don't, because basically if you're doing well, then buy more of you,
right?
So I can do well too. So I don't typically take it because it really is, a relatively small number. But it's once you build that portfolio to where you wanted that $5-10 million number where it's starting to give you like a good monthly income of a couple stacks like a month.
What are some realistic goals? Like you talked about, everybody went into like Bitcoin. Why are you laughing, bro?
I have the same question.
What is that? So what are some realistic goals? Like we talked about like Bitcoin. Everybody's like, yo, I'm going to buy Bitcoin at 15,000. It's going to go up to 30,000 and I'm going to be a millionaire basically. What are some realistic investment goals? Like I'm going to invest $100 a month. The typical person, what do you say the typical person is investing?
Okay. So let's say the median is 50,000. That's what they're making per year. If they're staying home with family, they have a lot of net income. Because they're not paying that rent ticket, that mortgage ticket to say. So someone like that who's netting maybe like $1,000, they may be putting in $250 to $500, depending on advantageous they are. Typically, my rule of thumb.
And that's a month, right?
Yeah, a month.
Okay.
So what I tell people is, when you're getting started, try to invest at least 10% of your gross income. Okay, at least 10%.
For the year or for the month?
For the year. I mean,
no, I'm talking about. You invest in monthly or yearly? How are you?
Honestly, you can do monthly, yearly, semi-annual, quarterly, a la carte. Literally, it's up to you. What I do like to have is some kind of monthly, investment, because the dollar cost averaging.
Yeah.
And what that is basically, if I bought it for 10 this month and next month it was at 8, it really in the middle it was at 9. That was the average on it. And that's what you want to take advantage, because you never want to buy something when it's high,
of course,
and it dips, and
you never know when it's gonna dip.
To really just put it in perspective, like imagine if you went to Zara and got the shirt for like $85 and tomorrow it was at $60. You'd be pissed.
Of course.
But in Zara you can return it and get that price difference. And in the stock market, that's yours, boo-boo. That's yours for that price. That's yours. So typically what I like to see happen is when we're first getting started, definitely 10% of the gross income is what we're shooting for, but inevitably we want to get to 20. We want to get to 20%. So literally, if you're making, $50,000 a year, you want to put maybe $10,000 a year into something. And there's different ways of doing it. Again, and I say on the record, I'm not allowed to give tax advice, but I can give you some options that will help with your tax liability. Ironically, I was listening to your podcast on the way here. Send me an episode, and you guys were talking about taxes, tax returns, stuff like that. And
killed this
how
year.
he got killed.
Damn. He
got killed in taxes. And I was just like,
we gonna do it right now.
Yeah, no, I'm right there with you. I waited so long. So literally, when you're talking about tax liability, there are investment accounts that will give you an option to invest and reduce your tax liability. Why would you not take advantage of that? If you work for a company, they offer like a 401k, a 403b. If it's a government, 457. These are all things that will help with your tax liability. On the flip side, if you're working sole proprietor, business owner, for you, it's an IRA, a simple IRA. It's a set plan or defined benefit, depending on where you are in life, how well you're doing in your business, whether you're on the ground floor or you're already opening up chains of stores. That's going to determine the type of account that you want to have. All right. So we're going to go with pre-tax and post-tax. Okay, so when we're creating the financial strategy, what you want to do is have something that is going to pay you well in the future, but not pay you so well that you don't get to really reap the benefit of it. All right, and we'll start with retirement accounts. I'll go long then go short. All right?
Yeah, I was gonna ask you, like, a lot of people think a 401k is enough. Like, do you feel like that's enough? Yeah, you go
one of the myths. Here's the myth now. All right, so a myth is I have a retirement account, so I am good.
I don't need
it says retirement account and I put 2% in it, you know what I'm saying?
And my company matches it.
It matches it, you know what I'm saying? So I don't need you, Mr. Financial Advisor. I got this. So, myth. It don't work like that. All right? We say financial freedom. I say, what's the number? You know, you got to say, what is your number? Do you want to have...
Do the math.
500,000 when you retire? And I ask this question, when do you want to retire? 50. All right. Well, the average age of retirement is about 67. So you gotta be heavy in the market if you plan on not working past 50.
Yeah.
I got my retirement account. All right. Well, cool. Let's do some numbers. Okay. Now you're 25 years old now. Okay. Before you can take what's called the qualified distribution from these accounts, you have to be 59 and a half. Okay. So that's about 34 and a half years before you can take this money out. So if you wanted to retire at 50, you got to wait 10 years to access this money without penalty and taxes. That's on that side. Okay, cool. Let's go into the actual, the you know, the steak and potatoes into it. I'm going to say this. A 401k is an investment account. I ask all the time, are you currently invested in the market? No. Do you have a 401k? Yes. You're invested in the market. There is some type of fund associated with it. It could be guaranteed interest. It could be U.S. Treasury. It could be a fund. The target fund is always good. So you're investing in the market, so you gotta know what you're looking for in the future. All right. So when we're getting to that retirement age, we've been building up this asset. How did you choose to do it? Pre-tax or post-tax? Did you know that you had an option? All right. What's everyone's favorite thing, and I can tell you what I get in all my consultations is Roth IRA. It's the only thing people know about. I should get a Roth IRA because they said so. They said to get a Roth IRA. All right, cool. I think a Roth IRA is a great step. But do you understand what a Roth IRA is? So there's no tax deduction. Okay, so that's cool. It's direct deposit money. So I take my direct deposit money and I put it into this Roth IRA. All right. It grows tax deferred. All right. And as long as I have it, you know, until I'm 59 and a half, all right, when I want to take a distribution from it, all the gains tax-free. We like that.
Of course.
We like that concept. You know, tax-free is a great, you know, avenue. Yeah. Who wants to pay Uncle Sam 20, 30, 40%? So that's all they know. That's not all there is to know about a Roth IRA. Now, I ask people all the time, well, that's great. Well, where do you see your income in the future? Do you think you'll ever make over 6 figures? Who tells me no? No one. So, I think I'm gonna clock out at 95 for the rest of my life. No, it really is. No, I definitely be in, 6 figures. You know, I have, real estate. You know, I have a business. You know, I'm growing in the company. I'm going back to school. Fine. If you go over $130,000 in income, you're no longer eligible to contribute to a Roth IRA. A lot of people don't know that. It slows down. You actually cut in half at $118,000. If you're married, the numbers are like $180 and then $196. So imagine you had this Roth IRA. You're in your 20s. You get into your 30s. You're making great income. Now you're making $150,000, $200,000. You no longer can contribute to this Roth IRA. Now it's still going to grow. Whatever money's in there, it's still going to continue to grow. But then now you're making so much more money. It's not. Your lifestyle is changing. So as your lifestyle changes, are you going to be able to compete, with this money that you have? All right, well, I'm able to take out maybe $2,000 a month from this Roth IRA, but my bills are $10K. Bills. Not like, I'm going out for a nice dinner, I'm going on vacation bills. So when we sit down, we definitely want to go over all options that are available to you. And what a lot of people don't know, and this is something that another myth I'll kind of get into, and as a segue, is insurance, life insurance in particular.
Okay.
I'm going to say on the record again, everyone should have some sort of life insurance policy. I don't care what it is. You can figure it out, the details later when you do talk to a financial advisor if it's in line with your goals, but you need to have some sort of life insurance, all right? That's just on the risk management side of it, all right? That's bare minimum. Let's take it to the next level. You can actually use insurance as an investment vehicle, okay? Depending on how you structure it, all right? There are products that are index linked. So basically, it might follow that S&P, it might follow the Russell, the EFA, and also you have variables. So those same mutual funds that you're putting into whatever your investment, or it's politically called a brokerage account, or putting into a 401k or retirement account, you can also put it inside an insurance policy. Now, the reason why you might want to do that is because, again, this also grows tax deferred, but potentially could be another tax-free form of income. And a lot of people don't know that. A lot of people just know, okay, cool, well, I didn't know you can buy investments inside of insurance policy. Right. Getting them to understand that they need insurance is even a more difficult conversation. It's just like, oh, that's for old people. Anything for old people you should have now. Yeah. I'm going to say that. Ask anyone who is 10, 15, 20 years older than you, ask them, hey, listen, is your retirement account important? Yes. Is insurance important? Yes. So these are things that you definitely want to have. So as far as the long-term planning, we want to make a combination of tax-free and then, the tax-deferred, because we do want to, reduce our taxable income. So you can actually structure it that whatever money you're taking out from that taxable account, it doesn't increase your tax liability. So let's say you're taking out $50,000 tax-free and then $50,000 taxable. Okay. When you go to the IRS, all right, I got to pay taxes on $50,000. Imagine if it was all pre-tax money that you're taking out now. You go into your, hey, listen, they're not withholding it. They're giving you the check. Oh, you're in a 25% tax bracket. Yeah, I'm gonna need $25,000. Yeah, I'm gonna need that right now. Would you like to come out your account today, or would you like to send a check? How would you like to do it?
Let me get back to you on that.
You know what I'm saying? Can I get a payment arrangement?
Story of my life.
Can I get a payment arrangement? Can we break this up? You know what I'm saying? Because I got to check in and save it. It takes 3 days to transfer. So I don't think it's gonna be there at time. So that's definitely like on the the long term planning. Okay.
So let's talk about we have a lot of older listeners as well, who have kids and things like that. How can they gear up and get ready to for their kids' investments? Like, say they're about to have a baby, or their baby's like 1 or 2, they want to get into college and things like that. What are some ways they can do that?
So there are qualified college plans. Coverdell, and the popular one is a 529, which is a state sponsored college plan. So if you're gonna go with a 529, know the pros, know the cons. Okay, so hey, listen, I have a son, he's 5 years old, so this is a conversation that I had to have with myself. Good, I could do this. So what a 529 plan is essentially you're buying mutual funds within this investment account. All right, all the gains grow tax deferred. All right. And as long as you use the money for a qualified educational expense, you can now take this money and all the gains on it tax-free. So, hey, listen, I put in $50,000 over the course of my son's life. It grew to $150,000. I take that, no taxes. The full $150,000 goes to him for as long as he's using it for college-related expenses, tuition, books, so on and so forth. All right, that's the pro. Okay. Let's look at the cons, okay? Because you got to know both sides of the coin. The cons are, when I went to school, what did I have to fill out? Everyone fills out a FAFSA form, okay? What do you have to list? Your assets. That 529, that $150,000 is a state-sponsored plan. So remember, someone's reporting that, hey, listen, he got that money. If you say he ain't got it, I got receipts. You know what I'm saying? I got receipts and screenshots. So when you apply for financial aid, it's going to show that you do have $150,000 worth of aid, already in a plan. Nah, you don't need that Pell Grant. And, that's another thing. Let's say, I was going back and I was talking to myself. You asked if I would do the whole college thing again, why I think it's important. Maybe I didn't really get the maximum benefit from it.
Yeah.
So I might not have gone directly to college. Maybe I might have tried to do something on my own. So if you have a child who, we'll go the positive way first, they get a full ride. Your baby was smart. 4.0, valedictorian, the whole 9. So he or she's going to school for free. Yeah. Now you have this $150,000 asset. What do you do with it? 9 times out of 10, what you can do is give it to someone else. But if that's your only child, hey, listen, you gonna give it to your cousin's kids? No. Hey, now, you know what I'm saying? I'm gonna need a little bit of this back. But what's gonna happen is that now you're gonna pay if you actually break it and I want to keep it for myself. Yeah. All the gains are taxable. Penalty. You losing about 30 to 40% of the gains.
Can you take that and say I just want to reinvest that money?
You can take what you get left.
Oh. So there's no way around that.
That's automatic.
You can have the balance, brother. That's automatic. That's automatic. So before they send you that check, they're taking that money out. Okay, and that is the con side of it. So typically, as a comparison, I would give some of my clients an option. And what I actually went with my son is something called the variable universal life policy, and that's what I was kind of briefly mentioning before. Because the concept in the scenario is a little bit similar. Because essentially, it's going to be for his college, and I'm going to buy mutual funds in it. So within this policy, I can buy mutual funds. So the same mutual funds I could potentially be buying this 529, I could buy it within an insurance policy. All right, cool. What's the pros and cons with that? There is a cost of insurance. That's if, God forbid, something happens to him, whatever benefit is paid out. That's not free. Okay? What's the other con? It's a 10-year surrender period, or 15, depending on what product it is. All right? So if your child is 10 years old and it's 10 years before you can access the full balance without a penalty, that might not be the right way to go about it. But you know what? On the flip side, when I do fill out that FAFSA, that's not considered an asset on FAFSA. So I can get that Pell Grant, whatever, that TAP, whatever they're giving out these days. I can get all of that because technically I have no assets. Okay. Also, on the flip side,
I don't know why. I think we're still recording. Oh, there we go. No, we were still recording.
We were still recording?
Yeah, the mics just went out. But yeah, sorry.
It's that awkward moment in the party. You know what I'm saying? Get the DJ.
Nah, they were hearing us. They were hearing us.
They heard the awkward silence. Damn, I hope I didn't lose my train of thought. You know what I'm saying? No, so definitely on the positive side is that you don't have to use it for school. Okay. There's no stipulation on what you use this money for. It could be used for anything.
You shouldn't use it for anything.
It could be. Yeah. I'm just saying that, with a 529, you have to use it for school, but you could use it. Now, that's how we really get creative with it. Maybe you're giving them an asset. They can buy their first home with it. They can give themselves a subsidized pension with it. It gets creative. But again, that really kind of comes now. Yeezys. I'm about to ball out. I'm about to get this Porsche be starting on everyone. Thanks, Ma. So, when you look at it like that, it's just a way of, just comparing things. Sometimes, depending on what the budget is, I would probably recommend both, just so you have both sides of the coin.
Dope. All right, let's jump back into your journey, your personal life. So you got all the stuff to become a financial advisor. You opened up your own firm. We talk about your short-term goals of like helping your parents out and your family, whoever took care of you out. What are some of your long-term goals?
My team laughs at me whenever I say this, but I want my own jet.
Okay,
that's real. And it's real. And I tell people, like, at the end of the day, if you think it's funny or it's unrealistic, that you shouldn't be in my circle.
Yeah, of course.
Because you know what? If I talk to other people, I talk to Diddy, is that far fetched? If I talk to Jay-Z, is that far fetched? So literally, that's who I want to surround myself with. So my ultimate goal is to continue surrounding myself with positive people. You hear everything. You can get motivational books, but every successful person says they surround themselves with positive people. People that help them grow.
What's your purpose of getting a jet?
Purpose of getting in the jet is so I don't have to wait in JFK.
Good time.
I don't have to wait in JFK, get there 2 hours early, and I get to sleep on the plane, things of that nature. And you know what? It's just a goal. I feel like I've achieved so many of my goals that I thought was going to take me 20 years, 30 years in order to do it, but I've already done that. So I got to do something that I can't present day do.
Yeah.
But you know what? I know one day I'm going to work for it. I'm going to get it one day.
It's crazy how your mindset switches when you start hanging around with different type of people. Like we talked about when I said to you, you skipped over 6 figures and you're talking 7 and 8 figures.
Yeah.
Like for somebody with the proper mindset, they might think, yo, I can never make that. So that's why I like bringing people on who have that mindset of like, yo, 6 figures, that's light. I can hit that, and then that's next.
It.
And that's the power of surrounding yourself around those people who are ambitious, who want that next level.
Exactly.
Who and you said don't surround your people with stuff. If you tell them a goal, like when you told me that goal of like you want a jet, I'm like, okay, that's possible. You're gonna get that.
Right.
That even for me, that's like, yo, that's a possible like
it's tangible.
Yeah. It's right there.
You can do that.
And that's the power of surrounding yourself around like a lot of successful people. Yeah. So we talk about like we'll be talking about finance this whole time. What are some ways that somebody can start learning? Like, do you have any books that you recommend to somebody? Okay, let me start my financial journey and see what I can learn and stuff like that. How do I get that base knowledge? What would you recommend?
So a book I would totally recommend is by Grant Cardone. Is Be Obsessed or Be Average. That is so the creator of the 10X rule, man. Like, and that's where I originally got like, you know, my jet idea from, because they said he couldn't buy a jet. I'm like, well, yeah, I want a jet too.
Of course.
You know, and a lot of times it really talks about, if you believe in something, you have to be obsessed with it. You have to be obsessed with it. And what obsession is basically is that literally no matter what, any kind of justification, when people tell you like, all right, you'll stay away from this, don't do this, it's not going to bring you this, you do it anyway because you just have to. It's your purpose. It you know, it really eats at you. So it really tells you to embrace that, as opposed to maybe like, you know, shunning it. You know, like, don't listen, because I heard it all. You know, again, remember, it's doctor, lawyer, engineer, disgrace to the family. So every job I typically had, or every career or venture I ever went on, it had unlimited earning potential. You know, with T-Mobile, it had a cap on what I can get, but it was commission based. You know, with
I worked at Sprint, so I know.
You know, so it has its commission. When I had my own event planning company, like, you know what, at the end of the day, I could throw an event and make $10, you know, after all the bills are paid, or I can make $10,000, and that's happened, you know. So if I have unlimited earning potential, I need to continue that. All right. And a lot of times, the things that we're gonna want to accomplish in life, the next level, are going to require you to be in that financial position. Okay, it's gonna require that. And you know what? Even looking at it like this, like, real estate basically is something that I'm really getting into right now. So, you know, whereas I had a whole plan of buying a home, you know, one house, you know, and living in it for like 20 or 30 years, you know, maybe after when I retire, I can give me a second home. I'm looking at 2-family houses right now in buildings. That's what I want.
Of course,
know, because I want to have it. I want units, you know, I want to occupy space. This square footage is bringing me this amount of revenue. And typically, you know what, that's not a conversation you can have with the average person. So if I'm not having this conversation, you know, with you, I got to be my biggest fan. I got to make sure I'm pushing myself to this. I don't need anyone to kind of give me that stamp of approval. You can do this or you can't do this. It's all, you know, fine and dandy on either side of the coin, wherever you stand. But I'm so obsessed with getting to the next level, it really just doesn't matter.
What do you do to keep yourself in that mode?
Well, I have a son, so that's definitely big motivation. But again, it's just that I made sure that whatever level I really maybe peaked out at, I made sure I consumed as much of, you know, as possible, so that I couldn't fall below. So I changed my cars. I bought 2 different cars. You know, at that point in time, you know, I'm paying off my mortgage. I'm paying off my parents' mortgage. You know what I'm saying? So I'm doing these things. So if I ever, you know, feel discouraged, or if I ever feel like, damn, this is hard, you know, if that faint, well, maybe you should do something else, you know, whispers in your ear. All right, well, what's going to cover all these mortgages and all these car payments? Nothing. So if it's not going to cover that, I got to get my ass up and go back to what I know, you know, and do it. It's just changing your habits, changing your mindset, okay? And you got to really embrace those things. That's what I really got from the book, is don't hide from those things, embrace it. Be like, hey, listen, you know what, this is who you are. Trust me, the people that, you know, you admire, not idolize, but admire, you know, they started from somewhere, you know, and you listen to their stories, like, you know, like Dwayne Johnson, The Rock, you know, highest paid actor, currently right now. You know what I'm saying? Look at Diddy, look at Jay-Z, you know, people that, you know, I really look at, like, in their competition, you and each other. Oh, I'm worth 800 million. I'm at $1 billion now at the end of the day. And if you can't see yourself there, literally, where does that come from? Where does that doubt come from? Who says you can't have it? You know, I guarantee you it ain't the person writing your check. So if that's the case, you need to start writing your own checks. You know, stop waiting for someone to give it to you and go get it for yourself. And when you know that it's out there for you, you accept it. You might not be a millionaire right now, but you know what? You know you're going to be. I just don't have all my money right now. But if you kind of really, really just follow that. Like, that's me. That's what I want. That's what I'm going to get. Stay focused. That's really where you'll be.
Yeah, I tend to tell people, like, the $1 million for me, I already believe I'm a millionaire. I don't have the $1 million to show you, but I feel like I have that mindset. And I tell everybody, like, that's the hardest thing to get. The hardest thing to get and develop is that mindset. The $1 million is easy to get. You'll get that once you educate yourself, once you surround yourself around the right people, and you start taking action. You'll get that $1 million. But the hardest thing to get is that mindset. So I mean, books like that, especially the whole Grant Cardone line
he's everyone.
You talked about finding your number. The Millionaire booklet that he has, that short book. That's a good one in finding your number and everything like that too. So his whole line of books, like we're heavy on Grant Cardone.
10x.
Yeah. We're definitely heavy. All right, so the one more thing, like your biggest failure, we talked about all your successes, you doing that. There has to be some bumps in the road. Every great journey, there's gonna be bumps in the road. What do you feel like your biggest failure or your biggest lesson on your journey to success was at this point?
My biggest failure, honestly, is, again, I feel personally, you know, your greatest strengths are your greatest weaknesses. And for the fact that, you know what, I know I can go out there and make, you know, 6 figures in a month. If I really, you know, if I'm networking, I got the right people, I'm structuring it right, I might not get it this month, but I know in a month I'll have that 6-figure check. Yeah. You know what? Because I knew I had that capability, I didn't go as hard as I needed to. And I had success early in my career that it came to a point that, you know what, I know I'll just go and write another case, or I'll go manage another account, and I'll be right there. And you know what? I didn't foresee when the markets change. And when the markets change in your personal accounts, and then, you know what, everyone's watching the news, because typically what you're doing is, as a financial advisor, you're making people investment savvy, and they can read these things and they can see it. Well, based on what you told me, that this might not be a good time to do this, that, and the third, and that's the truth. But at the end of the day, now I've already committed myself to maybe some kind of bills and some kind of opportunities, to the point that I couldn't. You know, and that was the hardest thing, is that here I am talking about budgeting, and you know what, I got so consumed in what I was doing and felt so invincible that I thought the rules didn't apply. And I always want to tell people, the rules always apply to you. Okay, they always apply. All right, whether you're making $10,000 a year or $10 million a year, your rules apply to you. Okay, so it's the same thing. So just make sure that you don't change that mentally, because you feel like the rules don't apply. And when you feel like the rules don't apply to you, that's typically where the failures kind of come in, and like definitely the bumps, because it's like you could have prevented it. And I think that was the biggest thing for me. It's just I felt like, I could have prevented this from happening if I really was just paying attention to what was on.
I hear you. You went like cruise control.
I went on cruise control. This is cool. You know what?
I'm good.
I'm just gonna go to Miami for a week. I'll be back. My assistant will take care of this. You know what I'm saying? And you come back and you're still in vacation mode. And I'm just like, all right, I'm gonna go to the gym for this one day. The summer's coming. You know what I'm saying? And then by the time you really get back into it, you're behind. And then you're trying to catch up. But you know what? You are a well-oiled machine, and when you slow that down, you got to get the momentum. And I lost momentum, and I felt that, you know what, that's really what kind of inhibited me. I mean, I missed the deal, you know, that was important, So I feel like, you know what, is to never lose momentum. Keep going, you know what, never slow down. Even when you think you got it, just keep going. You know what I'm saying?
Yeah. And what do you feel like is one word that would describe your current level of success?
Exponential.
Exponential. I go into that. Why is that one word?
Exponential. I use one word to describe my success. Exponential is because literally I was working 2 jobs. I had a business, had a portfolio, and I was clocking out about 95,000. You know, and I was proud of that. I was proud of that, and to have done that, and you know, in a couple months working maybe like 3-4 days out the week, it's just like, all right, well, I didn't have that as well as I thought I did. You know, and that's really what it is. It's just like when you get to a certain level, you know, literally, it just all changes for you. It's like a switch. Like, and I can tell you guys are all enlightened, and you know, you see all the way down. Might not be there right now, just the way I'm not there right now, but you see it, and a lot of people just see like right in front of them. This whatever's in front of them is all they see. And when you look all the way down, and you know that you can literally do anything, and what this will become, oh, it's exponential, because then you'll work that way. You know, it's hard to clock in and clock out to a job that you know that you're probably not going to get the, you know, the raise that you deserve, not going to get the position you're going to deserve, and probably have to kiss ass and not really like what you're doing. That's not encouraging. You want to know how to get out of this. You're too focused on getting out and doing anything else but being here. And you started, it's great. Oh my God, I love this place. And then 2-3 months later, it's like, damn, I need to get out of here again. So, you know, that's typically where, you know, I see it as exponential, because I'm so enlightened, because I know that I can do anything now. So now that I know that I can really get whatever number I want, let's test that. Let's test that theory, you know?
All right, so for the millions of people that's listening to you right now, as we wrap it up, like, what's that one thing you want to say to everybody when it comes to their finances? Like, what's that one gem you want to leave?
The one gem that I do want to leave is that when you start now, if you start today, tomorrow, if you start relatively soon, literally, you will thank yourself in the future. Literally, we always ask ourselves, if you can jump back in a time machine and give yourself one gem, something that you know what would have changed your life. You know what? I'm going to give it to you now.
This is you jumping back in time.
I already did this. I'm really 100 years old. You know what I'm saying? Start investing now. Doesn't matter where. Do something. Get familiar with interest rate. Get the taste of the market, because once you get the taste of it and the understanding of it, you're just going to want more, and know that everything around you is in the stock market. Your bank account's in the stock market. Chase, Bank of America's investing your money alone in and out, taking that interest, okay? That 401k you don't pay attention to, that you should be probably taking advantage of the full match that your employer is giving to you, but you need club money, take advantage of that, because that's in the market. Everything you buy is in the market. Probably the microphones we talk on, the cell phones we use, literally every cell phone company, the cars you buy, it's all typically either publicly traded or owned by a holding. When you look at it like that, why is everyone else getting paid but you? So get paid.
Drop it off.
Drop it off. We appreciate you for coming out. You dropped so many gems here.
Thank you for having me, for real.
And I was really wanted to get him on, because I knew a lot of people, like, we need financial help. Like, it's no given. Not a lot of people. That's something they don't teach you in school. They don't teach you how to write a check. They don't teach you about credit, life insurance. Like, all I feel like I came along knowing is my 401k, and they didn't even teach you that in school. So they don't teach you anything. So I feel like it's very, very important. And I want you guys to reach out. What's your how can people reach you, contact you?
There's several ways you can actually reach me. If you do the whole social media thing, it's Ross, ROSS Wealth Strategies. Okay. You know, spelled traditionally. Also shoot me an email. It's rosswealthstrategies@gmail.com if you want to do that. If you want to give me a phone call, I got a new number. You know, so that's 516-225-3907. That's my cell phone number, you know, and I made sure I wanted to be as tangible as possible. So again, it's 516-225-3907. Give me a phone call, shoot me a text. I do respond. I do get back. Just not like 11 o'clock on a Saturday night, please. The market's closed.
That's when you're enlightened. That's when you're enlightened.
It's just like,
you're sitting in the club like, damn, I gotta get best.
Yes, Mr. Johnson, your portfolio is fine.
No, and that's why I wanted to get you on. So, like, if you have any question, he's very, very accessible. He just gave you his cell phone number. Text him, email him. If you follow him on Instagram, everything will be in the show notes below. Definitely. So you can go in the show notes. You can find all his contact information. Definitely reach out to me if you have any questions, or you can email us at whatareyoudowingpc.com. You can hit us up on IG. Mine is way too irrational at Instagram. I always do that. And Handsome's is the Handsome Kelly _ Well, I'm off right now, but yeah, now we appreciate everybody listening. I hope you guys got a lot.
What's our podcast?
What do you mean?
You know, a podcast.
Oh, what are we doing? PC.
Okay, sure.
That's it. And everything will be down in the show notes. So definitely, thanks you guys for supporting. Like I said, if you have anybody else that we would want on the podcast, let us know. Contact us. I don't know if you want to say anything.
No, that's it.
I was saying we appreciate you for coming out. Like, man, thank you. And and if you have any questions, you can email us. Well, I'm sure we're definitely gonna have him back on in the future, and we'll save all the questions to the next time we have him on, or you can just contact him directly, and we'll make it happen from there. So, I mean, everybody enjoy the rest of your week. Whenever you're listening to this, I hope it's productive. I hope you guys are grinding. I hope you guys are doing what you guys need to do, and that's it. I'll talk to you guys later. Or next week.
All right, guys.
Later.